Hello everyone, welcome to the channel Just Try. In today's video, we are going to discuss about a few very important accounting terms. What are the accounting terms that we will be discussing today? The accounting terms are insolvent, solvent, bad debt, and provision for bad debt. What are the entries when we consider these terms, and how we deal with these terms in accountancy? We will also be discussing about provision for discount on debtors. Just we will touch up on that point because the previous four terms are very more important than this. So we will be discussing about all the 5 accounting terms in this video. So please stay tuned with the video and listen till the end so that you can get your concept clear.
Solvency. Solvency refers to a company's ability to meet its long-term financial obligation and debt as they come due. A solvent business has sufficient asset or income to cover its liabilities over the long term, ensuring financial stability. Solvency is measured by financial ratios like the debt to equity ratio and indicates a company's long-term financial health and viability. For example, a business with total assets of rupees 5 lakh and total liabilities of rupees 2 lakhs is considered solvent as its assets exceed its liabilities. Solvent. A person or a business is solvent when it has enough assets or financial resources to meet its current and future obligations. A solvent company is generally seen as financially stable and able to manage its debt over time without risking bankruptcy. For example, a person with a total net worth or assets of rupees 1 million and debt of rupees 2 lakh is considered solvent as they have more than enough assets to pay off their liabilities. Insolvency. Insolvency is the inability of a company or individual to meet long-term debt and financial obligation when liabilities exceed assets or if cash flow is insufficient to cover due debt. The business or individual is considered insolvent. Insolvency can lead to bankruptcy if the situation remains unresolved. For example, if a company's assets are valued at rupees 1,50,000 but its owes are 2 lakhs in long-term debt, it is considered insolvent since its liabilities exceed its assets. Insolvent. An individual or business is insolvent if it is unable to pay its debt as they become due or if its total liability exceeds its total asset. Insolvency often leads to financial distress where a company may have to restructure its debt, liquidate assets, or file bankruptcy. For example, a company with assets totaling rupees 50,000 and liabilities of rupees 80,000 is considered insolvent as it lacks resources to cover its debts. Bad debt. Bad debt refers to the amounts owed to a business by customers that are unlikely to be collected due to reasons such as customer bankruptcy or financial hardship. Bad debt is written off as an expense as it reduces the total accounts receivable on the balance sheet, reflecting a loss for the business. For example, if a customer owes rupees 5,000 to a company but has filed for bankruptcy, the company may write off the amount as bad debt because it is unlikely to be collected. Provision for doubtful debts. A provision for doubtful debt is an estimated amount that a company sets aside as an allowance or potential bad debt. It anticipates a portion of accounts receivable that may be collected in the future. This provision is created based on past experiences or specific analysis and is recorded as an expense, which reduces net income. For example, if a company has rupees 1 lakh in accounts receivable and it anticipates that 5% might be uncollectible, it will set up a provision for doubtful debt of rupees 5,000, that is 1 lakh's 5%, to cover potential bad debt. Provision for discount on doubtful debts. A provision for discount on doubtful debts is an additional allowance that a company creates to provide a discount to doubtful debts, that is, debtors who may not pay the full amount. This provision is calculated on the estimated doubtful debts and reflects the potential discount that might be offered to recover partial payments. For example, if a company estimates rupees 5,000 as doubtful debt and expects to cover 10% discount to these debtors to encourage partial payment, it sets a provision for discount on doubtful debts of rupees 500, that is 5,000's 10%. Table of key terms. First term that we have covered here is solvency, the ability of a business or individual to meet long-term financial obligation. Insolvency, inability to pay long-term debt or meet obligations, often leading to financial distress. Solvent, having enough assets to cover liabilities, indicating financial stability. Insolvent, lacking the assets or income to cover debt, posing risk of bankruptcy. Bad debt, amounts owed by debtors that are unlikely to be collected, written off as an expense. Provision for doubtful debts, allowance created to cover estimated uncollectible accounts receivable. Provision for discount on doubtful debts, an allowance for potential discount offered to the doubtful debts or encourage partial payments.
So I hope the concept of all the 5 accounting terms that we have been discussing today is clear, and please look into the other previous videos so that you can get the concept of the other accounting terms clear, because already we have discussed debtors and creditors in detail in a previous video. So please stay tuned in the channel, subscribe the channel, and like, comment and share this video so that everyone gets the knowledge of accounting and accounting information. Thank you.